You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kalakos and Marciano on CJAD 800.
Good afternoon, everyone. You're listening to The Real Estate Show. I'm your host, Terry Kalakos, chartered real estate and mortgage broker, as well as president and founder of Northeast Real Estate and Mortgage Agency. Today, we are continuing last week's discussion about what you need to know when you're investing in real estate, which is a subject that is very close to my heart. I love it. I've said it before. It's what's actually built my little, mini empire for me and my wife, who is looking at me going, just you? Really?
No. I know when you say you mean we.
That's right. Exactly. The voice you just heard is my beautiful co-host, Marciano, chartered real estate and mortgage broker and vice president extraordinaire of Northeast.
Of
Welcome.
The mini empire.
Yeah. And I do have to say just one thing. If you guys hear my speech slurring, it's not because I'm drunk. It's because I had a root canal this morning. A 2-hour long root canal, and my face is actually still frozen. So
yes, the longest roots the endodontist has ever seen.
Exactly. They go deep. My roots go deep. If you guys have any questions, feel free to reach out to us during the week at the office at 514-680-4674, or you can visit us online at nordest.ca. You can also visit our Facebook page at facebook.com/Northeast Mortgages. And if you haven't done so already, take a moment to subscribe to our YouTube channel, which is newsonthego.ca. And I do have to just say one thing. Doing a radio show with like a numbed up face, this is a unique experience. I just have to thank, Dr. Lieberman at the endodontist out in the West Island. These guys are amazing. I love these guys. So
yeah, I use them for mine as well. So
yeah,
definitely a good place to go to.
Good peeps. So let's kick it off right away. I know usually we do a little bit of a market update, but I mean the market is what it is. There hasn't been anything new and exciting that's happening. So we're gonna kick off the show right off the bat. Last week, we looked at the different ways to kind of invest in real estate. And we had, texters and callers, giving us a call, asking questions and stuff like that. So let's look at some of the stuff that we actually talked about last week, do a little bit of a recap, and then we'll kind of kick off the show, right? So what did we talk about? We talked about, when you're investing in real estate, you can be buying and renting out your real estate for long term. I mean, that's when you think
more traditional.
Exactly. So when you think about real estate investing, this is typically what people are doing. This is what people think about, right?
Yes.
But there's also, when you're looking, it doesn't have to be long term.
Yeah, it could be short-term rentals like Airbnb or any of those sites. It could be vacation rentals. It could be you buy a country house, you rent it out. So there's all kinds of other ways to rent out properties, of course.
Exactly. And, truth be told, I actually have, especially after the real estate market collapsed in the United States years ago, we had a lot of clients that came in, they did refinances on their properties here, and they ended up buying properties in the States. And when they bought these properties in the States, some of them, some people bought houses, some people bought condos in Florida, and they actually turned a really nice profit on it.
Some decided to sell them, some decided to rent them out. So everybody made their money differently. Some still have them, so it definitely increased their net worth. So they haven't turned around any liquid cash from it unless they refinanced it. So
yeah. See, this is one of the things that I love about real estate. And, a lot of times, and by the way, I'm a victim of this myself. When I was looking for that first property back in the day, I was born and raised in Milan, loved the area. So I wanted to buy something either in the Milan or the Outremont area. And the price points, were much higher than the rest of the island, even back then. At this point, it's completely, out of whack, that area, in terms of prices. But I was stuck in this area, so I kept looking for properties. And then finally somebody said to me, you know, are you buying this to live in it long term? Is this your like forever home that you're buying? And I said, no. I said, I'm buying it for investment purposes. So, and they said, so why the hell, I'm saying HELL, but they used a different word. Okay. Are you looking to buy in a market that has already gone up in value? Right. And one of the things that I love about real estate, a lot of times mentally we get geographically limited. Right. So our minds force us to go in a specific area because we think that is where we're going to make money.
Yeah.
That's where the trend is. Right.
Yeah. But right now you buy in the plateau or in my land, your rents don't cover your mortgage. If you're going for a traditional mortgage, if you're not living in it, if you live in it, and you're okay to be at a loss every month knowing that it's covering your...
A portion.
Exactly.
Yeah.
It's where you live, so it's fine. But I mean, on the other hand, if you're buying it really to turn around a cash flow,
those are not the markets to buy.
It's tough.
So I'm going to go back to what I always used to say. You know, the island of Montreal is a fairly small place. Real estate is very limited. On the island. So pretty much I believe that anything that you're going to buy on the island, and back in the day I used to tell people buy in Pointe-aux-Trembles. Prices of triplexes were like $40,000.
Yes, I remember.
And now it's skyrocketed, right? I know people don't want to live in Pointe-aux-Trembles, but it is a place that went up. And this is what you have to look at. You got to look at these areas and you got to say, where is the next boom gonna happen? Where is the next? So as a real estate investor, you have to expand your geographic area, not just only sometimes in neighborhood, but sometimes even in province. You know, maybe you're gonna want to buy Cornwall. Maybe you're gonna find some good deals in Cornwall and you're able to turn a nice profit. Maybe you can go up towards St. Jerome. Maybe you can go further. Toronto, I mean, Toronto, the prices are astronomical. We have clients that are buying in New Brunswick.
Yep.
Right? So it's important when you're a real estate investor to not get limited by the area. You want to actually expand. And, you know, you're going to say, how am I going to manage it? Property managers. How do I manage my properties? Property managers. Yeah. I haven't stepped foot in a single one of my properties in years. Yeah. For all I know, it could be in Australia, my properties.
So you say buy in upcoming... Up and coming neighborhoods versus neighborhoods that are already hot.
Exactly.
Because you want to know it's on the upwards trend, not already up there.
That's it. So, I mean, think about the stock market, right? When you hear about a hot stock, right?
It's too late.
It's too late. Yeah. It's the same thing in real estate. When you hear about a hot neighborhood, it's because it's already gone up in value.
Yes.
So what you need to do as a real estate investor, you need to be a hunter. Okay? Pick up the phone, call the city of Montreal and say, hey, which areas on the island are you guys giving subventions? That is a good indicator. Okay? So that in itself is a very good indicator so that you know which area can potentially be the next one that's going to go up in value. Make sense?
Absolutely. And we've seen it. So, you know, you're preaching to the choir here.
Yeah, of course. Absolutely. I mean, you've seen me do this and we've done it together for years, right? So I think that it's important to surround yourself with a good team that is actually open to looking around and taking a look in different markets and stuff. When we come back, we're going to be looking at some of the other ways you can invest in real estate. But first, we're off to the CJD Traffic Center.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kalakos and Marav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking about investing in real estate. You can reach us at the office at 514-680-4674, and of course you can visit us online at nordest.ca. So before we went off to traffic, we were talking about the different ways of investing in real estate. We covered, you know, buying and renting out real estate for the long term, also short term vacation rentals.
Yes.
Let's look at some of the other ways. Some of the other ways that people can actually invest in real estate.
Yeah. So last show we talked about REITs or real estate stocks as well. Basically buying a unit within a project where REITs basically hold and manage the property for you. They do everything for you.
Right.
You're basically buying.
You're a shareholder.
Exactly. You're a shareholder of that whole system, if
exactly.
you want. And we talked about joint ventures also, partnering up with people when you don't have certain capabilities or certain aspects. Let's say you don't have the down payment, you can partner up with somebody who's got the funds, but yet you have the know-how or the skill set to find the deal or the time to manage the property. So you complement each other. So that's a good way. We've seen a lot of people do joint ventures and complement each other, and that works. Also, I wanted to recap a little bit. Last week we talked about the different ways to earn income or to increase your net worth through real estate. So we talked about the traditional way, the passive income
that's generated from an actual company. I want to just jump back a second.
Oh, sure.
Okay, because we talked about the REITs, we talked about the joint ventures. Okay, I just want to, because I actually got a couple of callers that called us at the office, and they wanted to know more information about what we were talking about specifically when we sent JVs or joint ventures. Okay, so for those of you that listen to the show long enough, you know that there's 3 different elements that are required whenever you're buying a property and getting a mortgage on it. If you're not getting a mortgage, I mean, you buy it cash. You buy it cash.
Yeah,
It doesn't matter. But for the rest of us, there's 3 elements that are going to be looked at by the bank. So the 3 elements are your credit, your income, and your equity. In other words, how much you're putting down versus how much you're going to be borrowing. So let's dive into equity for a second. If we're talking about down payments, if you're buying an investment property, you need to put down 20%.
Yes.
If it's over 5 doors, you can get away with 15%. If you're going to live in it, and it's a single family home, a condo, or a duplex, you can get away with 5% down. And if it's a triplex or a fourplex, it's 10%. Okay. I know I just went through those really quickly, but actually on our YouTube, I'll actually put a link back to our show specifically on down payments. So if you're missing a down payment, but you have strong credit and you have good income, you could JV with someone, you can do a joint venture with someone that has the down payment but doesn't have the income. Yeah. That's what we're talking about.
Yes.
If you don't have credit, but you have good income and you have good down payment, then you could JV with someone that complements you. So the whole idea of a joint venture is to find someone who you can get along with, because this is going to become a business partner.
I say it's a marriage.
It is a marriage.
It's a marriage. Yep. It's a partnership. 100%. You better talk about the divorce before the marriage.
100%. And then once you have that, now all of a sudden you could go ahead and you could structure something and profit. Everyone profits from it. Okay, so I just wanted to, I'm sorry, I took a step back there.
No worries. It makes sense.
I just wanted to cover that a little bit because there was a lot of confusion when we mentioned it last week. And like I said, we did get a couple of messages of people asking just for a little clarification.
Yeah, okay. And sometimes you might have the same, both of you have all 3 elements, but you have something more than that the other person doesn't. Let's say you're very handy. You might be a general contractor. We've seen general contractors partner up with people who didn't know how to screw in a screw. Yeah. And it worked out because basically they joined. They said, let's buy this property together. I'll fix it up. You'll manage it. You know, so there's agreements that you come to together to complement each other's skill set, credit, or financial situation, whatever it is. These relationships, that's the whole point. If you have the same skill set, the same type of everything, then at the end of the day, you're not really complementing each other.
Exactly. Okay. Anyways, I apologize. I took that step back. I thought it was important. Let's go back to what you were talking about. Let's talk about the different types of incomes and the different ways that you can actually increase your net worth with real estate.
Yeah, so we did mention last time, just a quick recap, passive income or cash flow. So that's your traditional rents coming in.
Right.
You pay...
dollar comes in, 50 cents goes out, you're left
you
with
pay your
50
expenses.
cents.
Exactly.
Passive income is created. You got your cash flow.
That's it. Then you've got the passive appreciation,
right?
Which was basically you bought in a neighborhood that was up and coming.
You bought at 100,000.
Yeah.
And
it's now 200,000.
Worth 200,000.
Exactly.
So that's your passive appreciation. That's the increase in the value based on the market conditions.
Exactly. And you can use that passive appreciation eventually to refinance or to just grow your net worth. But that's another story. Active appreciation, you're doing something actively to grow the value of the property, whether it's renovate, whether it's increase the
rental
rents.
Rent, yeah.
Exactly. Whether it's bring in laundry machines that are going to collect income, whether it's rent out parking spots.
Yeah.
So, there's ways of increasing the value of a property.
Let's just go into that 1 second, okay? Because I really like when we're talking about active appreciation. A lot of times people think that they can buy a property and they could just jack up the rents and all of a sudden, the value of the property goes up. That is true in some cases, and in other cases it's not, okay? And this is important to remember. When you're buying properties that are under 5 doors, you're buying condo, single family home, duplex, triplex, fourplex, the value is not based on what's called the economic value. So the economic value takes into account the rent revenues, the revenues of the property. The value is based on what the market dictates, right?
It's more of a comparative analysis.
Exactly.
Yeah.
So just be aware of that. If you have a 12-unit building and you're able to increase the rents, the value of the building will go up because the rents have gone up.
Yes.
But when you have a triplex, just because you increase the rents, it does not increase the value of the property. It's important to remember that because a lot of times people kind of get confused over these things, okay? So anyway, sorry, please go on. And then we're talking, the last one we're talking about is principal recapture.
And that's an important one. I know that we don't have a lot of time before the news, but that's an important one to go into detail, basically getting back that principal and using it for your next project.
Okay, we'll dive back into that after the news. When we come back, we're going to be looking at how to get approved for your real estate investment mortgage. As well, we're going to be looking at going a little bit deeper into principal recapture. You're listening to The Real Estate Show on CJAD 800.
Welcome to The Real Estate Show with your real estate and mortgaging team, Terry Kalakos and Marav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're continuing last week's discussion about real estate investments. We're going to be getting into passive appreciation in about 2 seconds, but before we do that, don't forget you can actually reach out to us during the week at 514-680-4674, and of course you can visit us online at nordest.ca. And I'm going to say this. If you haven't
subscribed to our YouTube channel at newsonthego.ca.
Exactly.
You see? But I don't threaten people like you if you haven't done so already.
Shame on you. Shameful.
And we're not diving back into passive appreciation. We're actually diving back into principal recapture.
Excuse me. Yes, principal recapture. Excuse me. Yes, you're so right. I got a look from Rob when I said that. She was like, what are you talking about? Anyways, all right. So principal recapture. Let's go into that.
Yes.
So
I think that's the bread and butter of real estate, honestly.
If you use it properly.
Yes.
If you use it properly. And that is the key.
So let's explain what it is first to not confuse everyone.
Go for it.
So principal recapture.
You pay down your mortgage.
You either paid down your mortgage or you've improved the property or increased the value of the property somehow, or it's gone up in value thanks to the market. And now you see there's equity available in there. And you say, hey, let me pull out that equity and let me reuse it. Basically, it's a refinance.
Yeah.
And let me use that money to invest into another property, etc. If you're doing it right.
Exactly.
So you were saying it has to be done right. So let's explain that.
So what do I mean by that? A lot of times, and I'm measuring my words here. Okay, and the reason why I'm measuring my words is because every time I start talking about stuff like this, I end up getting slews of people, accountants and different people texting and calling me and challenging me. Okay. When you do a refinance of a property, to recapture that principal that's in it, what's happening, right? You're taking money out. When you take that money out, first and foremost, depending on what that money is used for, you can make it tax deductible or you can't. Okay. If I take that money back out and I stick it in my bank account and then I go on vacation with it, you can't write off the interest on it. Okay. I just want to
because you used it personally.
You used it personally. And it's not smart to do that. The other thing, let's say we take that money out and now we use it for investments. You invest it in other real estate investments. You buy a REIT with it. I don't know. You do something with it. You buy
stocks or whatever.
Whatever. You all of a sudden now it's for investment purposes. There is you could write off the interest, but that's not really what I want to get into. What I want to get into is a lot of times we get into this mindset as real estate investors, as homeowners, that we want our mortgages to be paid off as quickly as possible. Okay. The amount of times that I've heard that, I mean, everyone says that, which is fine on the surface. But when interest rates are hovering at 1.8%, does it make sense to rush to pay that off? Right? Can't you do something more productive with that money?
I get it.
So when you're doing a recapture, when you're refinancing, it's important that you look at, and this is what we do. This is what I do. This is what a lot of our brokers at the office do. What we're going to do is we break it down, okay? And we look at your net worth. And we say, what is your ultimate goal? Your ultimate goal is to pay off your real estate. Why do you want to pay off your real estate? You want to pay it off because you want your net worth to go up. Okay, I have news for you. The net worth equation, and you guys have all heard me say this, is net worth is equal to assets less liabilities. It is literally 1 + 1 = 2. Or in this case, it's,
2 - 1 = 1.
Exactly, okay? So it's a very, it doesn't, the net worth equation does not get any more simple, okay? And a lot of times people, what they're going to do is they're going to focus their energy on getting rid of that liability, right? So the liability being the mortgage on that property so that they're able to increase the net worth. But you can also do that by basically, if you increase the liability and you transfer that money over into your assets column by way of another investment, now you have more assets working for you.
And those assets will grow, which in turn will increase your net worth.
Voila, exactly.
So you're saying, let's say you have a, $500,000 mortgage. You have a $500,000 property. You take $100,000.
Yeah.
You buy another property with that $100,000. Now that new $500,000 property will also increase.
That's right.
So basically you have two properties working for you now.
Exactly. So now you
obviously you have to be able to support both mortgages at that point.
Absolutely. But the key, right, and this is the other part of the equation that I say, you shouldn't be buying a property that doesn't support itself. Okay, yes. It doesn't make sense.
That I've seen a lot. I've seen a lot of people with cash flow negative properties, and maybe in the short term, if you have a big plan, a good plan to bring it out of a negative cash flow situation, maybe that could work. Or like I said, if you're living in it and you can justify that money coming out of your pocket every month for the fact that you're living for free or for a very reduced amount of money, then yes. But otherwise, I agree. We always tend to look for properties that are cash flow positive from day one.
If you don't have cash flow, you have to have a clear sign of where your return is coming from, okay? You have the benefit in real estate where you don't have to necessarily be speculating, okay? You got to have a clear path, okay? And now I'm going to quote my mentor in real estate, which was Robert Kiyosaki many years ago. And he basically said, when you're buying real estate, when you do an investment, you have to see the win. How do I make money? How am I making money going into this deal? If you cannot see yourself making money in this deal, don't do the investment.
Yes.
Okay. And my first property, I mean, it's a joke. I say it and people laugh. I bought it for 107, right?
Yep.
But had I bought it the year before, it would have been 60, 65, 70 that I would have paid for it. People laughed at me. They truly laughed at me. They said, you're buying a property that's gone up in value. It's almost doubled compared to what it would have been in 1 year. This is crazy. It's asinine. Okay. But I still bought it because for me, the win that I was seeing was I put $26,500 down. That included my notary fees. And my profits annually were $14,000.
So that's a return.
Yes, my rate of return was more than 50%.
So after you paid your mortgage and everything, you were left with $14,000 in your pocket.
Exactly.
And so basically...
And I lived in it.
Yes.
To boot.
So you lived for free.
And I lived for free.
Yeah.
Okay, so for me, I was like, this is a no-brainer. Within 2 years, I recaptured all the money that I had actually put into it, right? Just in rental revenues that came in. Within 3 or 4 years, I refinanced it, which helped us start investing in other things.
Yes.
Right? Now, let's go to yields. Okay? We don't have we're against the clock here, but I do want to touch on yields a little bit. Yields are basically how much money you're putting in versus how much return you're getting back out. And as long as the yield makes sense, then go for the investment. Now, is the property going to go up in value? But you need to have a clear indicator that it's going to go up in value. If you don't have that, don't buy it, right? Don't speculate, because speculation will kill you.
Yes.
Okay, it'll kill you financially. It won't literally kill you. When we come back, we're going to be looking at what you need to know when buying an investment property. You're listening to The Real Estate Show on CJAD 800. Now we're off to CJAD Traffic Center.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kalakos and Marciano on CJAD 800.
Thanks for tuning in. Today's talk is about investing in real estate. Don't forget you can reach us at the office at 514-680-4674. So right before the break, I was about to say break.
You're hungry.
I am hungry. And again, my mouth is asleep here, right? So we were talking about... what were we talking about? I don't even remember what we were talking about. We were talking about yields,
yes,
right?
we were talking about yields.
So we were talking about yields, and we were basically saying, how it has to make sense when you're going into a real estate transaction. You have to see the win.
Yes.
If you can't see the win, don't go into the deal. I am just as happy for the deals that I didn't do than the deals that I did do.
Yeah.
Okay.
And you know what? Even banks, that's how they look at deals. They have to be winning from the get-go. So I know on the residential side, they still use comparative market analysis, or they'll use basically comparables in the area, things like that. But on the multi-residential side, again, I always say between 5 and 8, it's really a gray zone.
It's a gray zone, yeah.
Every bank treats
no man's land.
Every bank treats it differently. I noticed a lot of banks still like to squeeze it into the residential side. It just makes sense. It's usually not like a big investor and, having the fees and all that. It becomes like a costly endeavor. But over 8, let's say, the lender really looks at debt service coverage ratio. Like they want to know you're buying something that is lucrative. It's going to cover your debt. And they have certain numbers. So some will say 1.10, 1.20, 1.25. And basically what that number means is after all your expenses are paid and all that, they want to see that the revenues it's a multiple 1.25 times your expenses. You understand that number? So it's basically, they're basically saying, we want to see that the revenues from this property will cover all the expenses and then some, plus 25%. Let's say if we're talking about a 1.25.
Exactly. And that's why when you're talking over 5 doors, okay, the income of the individual is not as scrutinized. The only time the income of the individual is actually looked at is when the property doesn't meet the actual debt coverage ratio that the bank wants.
Yeah, and even at that, they still really, because you're buying a business.
Exactly.
When you're buying a building over 8 doors, it's a business. Let's be real here. There's revenues, there's expenses, there's management, there's all the things that are involved in running a business. So they look at your property like a business. And that's it. So, and again, and you've got CMHC in the loop. CMHC, if you're putting less than 25%, CMHC will be doing their own analysis. And often the number won't come out to what you're paying.
Yeah.
So let's say you're buying a building for $1.2 million, but the insurer comes back and says, wait a minute, after calculating all the rental revenues and all that, we assess that the value is $1 million. So we'll lend you 85% of $1 million.
Yeah.
Not
so
85% of 1.2 million. Now you have a shortfall.
Exactly.
So you have to be okay to add money out of your pocket if you have a situation like that.
Or can you go back and renegotiate with the actual vendors?
You could.
Have you seen it?
Have we seen, like, nowadays everything is over asking? Let's say if we had this conversation last year, I would say yes.
Yeah.
But yes, you could. But at the end of the day,
right.
Nowadays, for example, a lot of properties are selling without CMHC. You have to have the 25%. Otherwise,
and why is that?
You can't be putting in an offer asking for 80 days for financing. Right. You understand when you've got another 20 offers.
Sorry, that it's just for our listeners to know, the 80 days is basically the delays within CMHC right now. And we're not talking about residential. We're not talking about, houses. You want to buy a house. The delays are not 80 days. But when we're talking about multi-residential properties where you're putting less than 25% down and the mortgage is CMHC backed, the delays currently at CMHC
for them to look at your file is 80 days.
80 days.
So again, what we suggest, buy it conventional, buy it with 25% down or cash if you have it, and then go back and refinance and get that extra money that you are hoping to get if you want to refinance it to 85%. Again, because it's such a busy time, last year I wouldn't have this conversation with you. I would say go for it, put 15% down. We're good with CMHC now.
I'm just gonna. I'm gonna get hate mail for this. I'm gonna get hate mail. No, I'm gonna say it because it's really important. The real estate broker that you use, okay, and listen to me very carefully, everyone, is so important in a multi-unit transaction. You cannot go to the lady or to the man who is doing condos, buying and selling condos and duplexes or triplexes. It's a specific type of breed of real estate broker that's going to go past a certain number of doors. And they need to have, first of all, they need the license.
That's what I was going to say. They need the commercial real estate license.
But even when they have that license, a lot of people will get that license just for the fun of getting it, okay, hoping that they're going to make some extra cash from it. The reality is very different, okay? When you're used to the residential real estate market and you go into the multi-unit space and you have a buyer that comes in and says, I need 80 days for financing, they freak out. Okay, no, you can't. You need to put 14 days, 15 days, because they don't understand, okay? So listen to the words that I'm telling you. If you're deciding to buy a property that's over a certain number of doors, over 5-6 doors, you need a you need a mortgage broker. Excuse me, sorry.
Commercial real estate.
Commercial real estate broker that knows what they're talking about and what they're doing. Because if you don't, you are going to end up in a world of problems.
Absolutely.
Okay?
Absolutely. And that real estate broker also will do the analysis of the numbers for you if you've got the right person.
Exactly. Absolutely. 100%. I'm sorry. I had to say that because the amount of times that I've had people come in for multi-units and I get 7 days for financing.
Oh boy.
For an 8-plex. Or
unless they have a huge down payment. And
no, it's not. It's, I want to put, 15% down, 20% down. And they're coming with 7 days or 10 days for financing. And I call the real estate broker and I say, what are you doing? So it's just very, very, very
at the end of the day, like you say, surround yourself with the right team. Yeah. Real estate broker, accountant, mortgage broker, banker, whatever it is that you need.
Absolutely. Rav, we've covered like a whole bunch of subjects here.
Yes.
We've run out of real estate. If people want to reach us at the office, go for it.
You can reach us at the office at 514-680-4674, or you can visit us online at www.nordest.ca, so NORDEST.ca.
And if you haven't done so, please take a moment to subscribe to our YouTube channel, which is newsonthego.ca. Till next week, everyone. Have a blessed week. Love you all.